Okay, let's dive right into this explainer and unpack what has honestly been a truly wild week in global markets. We are living through this incredibly historic moment where massive, top-down geopolitical shifts and some literally mind-bending tech leaps are suddenly slamming headfirst into the everyday, physical limits of our planet, and our economy for that matter. It's this fascinating, high-stakes tug-of-war between absolute market euphoria and a very grounding structural reality. And you know, nothing illustrates the illusion of independence in our financial system quite like this chain reaction. Think about how this flows. You get a geopolitical catalyst, right? A canceled strike and a peace deal in the Middle East that pushes toward reopening the Strait of Hormuz. That immediately ripples out. It acts as the primary effect, sending Brent crude oil dropping below $90 a barrel, which in turn triggers a massive secondary effect. We get a broad equity rally, the Nasdaq jumps 2.5%, and airlines absolutely surge because they're expecting some serious jet fuel relief. Everything is completely connected.
So, to make sense of this incredibly complex web of cause and effect, we're going to break things down into 5 key areas today. The relief rally illusion, the space mega-cap era, the AI infrastructure pivot, hidden global frictions, and finally, the consumer impact zone.
But start with part 1, the relief rally illusion. That averted strike in Iran, it acted as a massive release valve for the capital markets. The immediate surface-level effect was a huge 4.2% plunge in oil prices, dropping treasury yields and the Dow pushing past the historic 50,000 mark. Honestly, on the surface, it looks like a pure, unadulterated economic victory.
But right beneath that surface-level relief, there is a hidden stabilizer at play. While everyone was celebrating geopolitical peace, China was quietly masking some major global economic tensions. Beijing actually secretly initiated drawdowns of its national strategic reserves, hiding what essentially amounts to a missing 3 million barrels. And on top of that, they experienced massive domestic demand destruction. We're talking transit shifts with less driving and intentionally throttled industrial plant operations. So this hidden demand destruction is what actually kept the global economy humming despite the Middle East volatility. But it begs a huge question. What happens to prices when Chinese buying inevitably resumes?
Which brings us to part 2, the space megacap era. $1.8 trillion. Just let that staggeringly massive number sink in for a second. That is the initial valuation for the single largest initial public offering in the history of capital markets.
SpaceX has completely redefined the boundaries of tech here. They just launched an IPO raising $75 billion at $135 a share, and their goal is a mind-boggling 1 million operational satellites. But there's a very serious market mechanics warning flashing red right now. The exceptionally high allocation of this IPO going straight to individual retail investors has created an absolute frenzy, and it's a frenzy that severely risks straining the actual trading infrastructure of U.S. capital markets.
Now, what's really fascinating is the underlying engine driving that astronomical valuation. It isn't just rockets. It's a compute flywheel. Starlink's global broadband constellation acts as a foundation. SpaceX is actually using AI coding tools to pull their compute power in-house, accelerating the training of their own proprietary AI models. By leveraging internal hardware to host and monetize these models, they've drastically compressed their private equity valuation multiples, dropping all the way from 100 times down to 39 times trailing revenue. It's a total game changer.
And that heavy focus on physical compute perfectly sets up part 3, the AI infrastructure pivot.
We are in the middle of a violent rotation of capital right now. Money is sprinting away from software and pouring straight into silicon. On one hand, you have the software squeeze. Legacy enterprise software giants are struggling to monetize their massive AI bills, while consumers are migrating to cheaper open-source models. But on the flip side, we have the infrastructure boom. Private equity and venture capital utility investments are up over 50% globally. The capital is literally running away from the software layer and funneling directly into the hard, physical infrastructure needed to actually power it.
The details here are stark. You've got Meta struggling with an $8 chatbot and Oracle erasing its year-to-date gains. But while legacy tech struggles to monetize AI software, the real money is pouring into physical assets. We're talking Project Helix launching a $10 billion fund for data centers, nuclear, and gas power, literally just to keep the AI lights on. Meanwhile, Anthropic is deploying $35 billion into hardware. It's a modern gold rush, but private equity is out there mining for physical capacity and power grids instead of gold.
And that physical demand brings us to part 4, hidden global frictions.
This is where things get both stunning and honestly a little terrifying.
We are basically treating the upper atmosphere like a giant chemistry lab right now. When these thousands of satellites reach the end of their lives, they do a controlled descent at Mach 25 and incinerate in the mesosphere. That vaporization deposits space junk molecules, things like aluminum, lithium, and copper, straight into the stratosphere. These metals act as catalysts that free up ozone-destroying chlorine. By 2029, we're looking at projecting 870 tons of soot per year up there. It creates an artificial cooling effect up high while simultaneously trapping heat and warming the ground below us.
And the blast radius of this massive space expansion? It hits the ground hard, directly impacting the stock market. Starlink's massive footprint is a direct threat to traditional telco monopolies. Think Verizon, AT&T, T-Mobile. Plus, space peers are dealing with insane volatility. Take AST SpaceMobile. They have a 20% short interest right now, which is 4 times the market average. That puts them at risk for some severe short squeezes as everyone tries to compete with this new SpaceX benchmark.
Quick side note here, but it's absolutely crucial. If you're a retail investor getting caught up in all this space and tech hype, and you're eyeing those leveraged single stock ETFs that promise double or triple returns, please look at the historical data. Mathematically, these vehicles destroy wealth over time because of volatility decay. We've seen funds like the ProShares Ultra Pro Short QQQ lose over 99.9% of their value previously. It is a massive, massive risk to retail portfolios.
Let's bring this all back home to Part 5, the Consumer Impact Zone.
Down here on the ground, we are facing a macro triple threat convergence. Number 1, persistent wholesale inflation just jumped to 6.5% annually. Number 2, the Fed is under huge pressure to mirror the European Central Bank with impending rate hikes. And number 3, companies are actively preparing job cuts in sectors like leisure and hospitality to protect their margins. All 3 of these massive pressures are converging directly on lower-income consumers, hitting them with rising credit utilization, falling savings, and shrinking wages.
Because of this squeeze, consumers are completely changing how they operate. They're heavily leaning into travel arbitrage. U.S. domestic flights are up over 30%, so people are abandoning them and pivoting to Europe, where hotel rates in places like Rome and Florence are actually down. To fight those rising utility costs from the AI grid strain we talked about, people are embracing energy independence with DIY plug-in solar panels. We're seeing intense local entertainment booms as people stay closer to home. And on a macro level, this cost of living crisis is sparking systemic immigration pushback, even pushing voters in Switzerland to consider permanent population caps.
All right, let's pull all of these threads together in our conclusion, the belief matrix.
Right now, parts of the market are absolutely high on technological euphoria, the massive space economy expansion, the rapid adoption of open-source AI. But when you map that against structural reality, a different picture emerges. The massive AI infrastructure megabuilds, a highly strained consumer base facing credit defaults, SaaS pricing totally eroding, and the very real long-tail environmental degradation happening in our atmosphere. These frictions are quietly but rapidly accelerating. The market is running on relief, but the physical limits are closing in.
So I want to leave you with this question to ponder long after this explainer ends. As we aggressively push the boundaries of what is technologically possible, are financial markets effectively pricing in the future, or are we just blindly ignoring the very real physical and economic frictions standing right in front of us? Keep learning, keep questioning, and I'll see you in the next one.